Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. In this podcast, we are focusing on a very insightful new paper that details an exceptionally interesting way, to me anyway, to build net zero portfolios and how one Danish pension plan actually did it. You can get this paper by downloading it from CFA Institute's website, and our guest today is one of the authors, Fred Samama. Fred is head of strategic development at Sustainable One, part of S&P. Previously, he had several roles at Amundi, and before that, he was at Credit Agricole. He's a graduate of Stanford University. He's also just recently published a book and will be teaching at Columbia University here in New York City soon. So, welcome to the podcast, Fred.
Thank you, Rob. I'm very glad to be back. So thank you.
So this paper, by the way, I really do urge people to download this thing because it's part of your membership, CFA Institute. It's excellent. One of the things that I thought was really interesting right from the beginning of it is, we're in this world where the number of assets in net zero portfolios is now estimated about $130 trillion. But constructing those portfolios, while easier, is still kind of complicated. And your paper outlines a construction methodology that's a big step forward. So can you sort of set the stage for the issues a little bit and also then just tell us about the key concepts in the paper?
You're absolutely right, Rob. In Glasgow, just a few years ago, investors representing $130 trillion took the commitment to be net zero. $130 trillion is an outstanding, amazing number. And even if we have double counting or whatever, it remains something unprecedented. But truth is that a few years later, when we observe what has been delivered, it's fair to say that pretty much little has been delivered. So there's a gap between investors' commitments and what is concretely put in place. And when we ask investors why are not you delivering, and in a certain sense, having a reputational risk, we can hear two main reasons. The first one is that really part of my fiduciary responsibility to be net zero? And second, if I've answered yes to the first question, by doing so, do I create new risks that are leading to the same problem, meaning that is that, again, part of my fiduciary responsibility? So that's really, I would say, almost an industry challenge to keep commitments. And here we thought that with my co-authors, we thought that we could bring a solution to the market. Let's start with facts.
Yes, please.
The facts is the fact that governments have recently decided to be net zero. These commitments were representing only 10% of the emissions back in 2018. In 2021, the very same 10% became 70%. And some countries have even taken this commitment and put them in the law. So they are legally binding, like Canada, California, Chile, UK, Europe, South Korea, Japan, New Zealand. By the way, countries where you have massive pools of assets. So globally, all these governments are using the IPCC as a North Star and saying we are aligned with the IPCC objective, meaning being 1.5 degree benign. Truth is that the world is not there at all. For example, at S&P, we estimate that the world is around 2.4 degrees. So we have a gap between what the governments are saying they want to achieve and the current situation. In a certain sense, it's like when the inflation is at 5% and the Fed says we want to achieve 2%. If your portfolio is exposed to the interest rates, you have a risk. And here, similarly, we say that there is a macro risk between what the governments are saying they want to achieve and the current situation. And that risk can materialize in two ways. Either governments can implement regulations in order to bring the 2.4 towards the 1.5, like in Europe, where the entire car maker industry is being reshuffled through regulations, or like in the US, with incentives, the famous IRA. But in both cases, if you manage portfolios, you're exposed to these different regulations, and it's part of your fiduciary responsibility to find ways or means to hedge this macro risk. And one solution is pretty simple. If the governments are using the IPCC as a North Star, let's have IPCC aligned portfolios. Let's already align the portfolios with where the governments want to land. That's why IPCC aligned equity portfolios. So it's a certain sense, it checks the problem number one, macro risk, macro hedging. But then we have the problem number two, does it create portfolio construction risks, knowing that many solutions are getting rid of oil and gas companies? We know that they have performed well, so many investors have lost money, and so they are not comfortable in entering similar strategies. And here, with the methodology, we make the case that we can be IPCC aligned with a sector neutrality, meaning that we keep the same exposure to the energy sector, utility sector, and so on and so on. And we even have a very low tracking error. In 2024, it starts at around 40-ish basis point, and it remains about 150 by 2050. So many investors can stomach these limited tracking errors. And so then we tackle the problem too as well.
Yeah, I mean, this is the name of the game for asset owners who are looking at a transition. Is all about tracking error, right? All the way up to the CIO is responsible to the board and ultimately to their beneficiaries.
Absolutely. That's why to have these two aspects, really, why should I do that? Because it's a macro risk. Does it generate a new portfolio risk? The answer is no. And I'm sure we will have the opportunity to speak about PenSam, but it was really their main concern. They wanted a solution with a low sector deviation, a low tracking error. And after having studied everything available in the market, they came to the conclusion that this solution was the right one.
Yeah, their story is fascinating. But just before we get there, I'd like to talk about something, pardon me, this a little earlier on in your research about low carbon indices and the state of those, because that's the other name of the game for the asset owners is in addition to being able to have low tracking error, how do we know how we're doing? so, so you talk a little bit about what you found there, please.
Yes, it's pretty straightforward way of thinking. Once we've said that we should have an IPCC aligned portfolio in order to hedge the macro risk, then the question is, what does it mean concretely? What does IPCC say? Step two. IPCC is very clear. In their 2021 report, the most recent one, they said, we, the planet, if we want to limit the increase of temperatures by 1.5 degrees with 83% probability, we, the planet, we have a 300 gigaton CO2 budget. That's the only thing we can plug into the atmosphere. And here it's fascinating because we have a starting point, the current emissions. We have an end point, 10 gigaton in 2050. And in the meantime, we have a volume of CO2 that we can spend. And in 2024, it means to reduce by about 30% the volumes of CO2 every year. And then we thought that, okay, if it's true for the planet, it should be true for the proxies of the planet, the economies, and the proxies of the proxies, the indices. So very concretely, we take the minus 30% and we plug it into an index. What does it mean? Is that we observe the carbon footprint at the beginning, and then every year we will reshuffle the portfolios in order to achieve an ownership of carbon emissions being reduced by 30%. Either because the corporates will do the jobs, maybe, or they won't reduce the emissions enough to reach this objective, and then we will sell the high emitters and buy the low emitters in order to align the portfolios with a trajectory that the IPCC has said being a 1.5 one. And it looks very simple. It is very simple. It's very transparent because on the one hand, the carbon budget comes from the IPCC. On the other hand, we observe the carbon footprints of the corporates, Scope 1, 2, and 3, and we have a very straightforward methodology. But where it becomes super interesting, because we can invent whatever, but does it fly? Here we made tons of simulations, and one of them was to say, let's imagine that the corporates are never to do any efforts. Hopefully, it's not the case, but let's have a kind of worst case scenario where exactly. We are laughing, but that's not that fun. But yeah, yeah, exactly. Exactly. And here we observed, because it's not intuitive, that also a very conservative assumption of corporates not doing any efforts, we could still have the tracking errors I spoke about before, meaning started at 40-ish basis point and remaining below 150 basis point. Why? And we make the case in the paper because we already have in all the sectors, some low carbon emitters. We already have Teslas here and there. And so we can already build portfolios with this low carbon footprint.
Yeah, this is to me, this is one of the more interesting parts of the paper is that the changes have already happened. I mean, the tracking errors find that more asset owners can do this, right? Because it's already gone. This is, by the way, page 9 and 10 of the study, in case you're looking at it, in case you're following along at home, this is where it is. So, okay, so let's go on to the Dutch asset owner now, because right now in
Danish.
this,
Danish.
yeah, I'm sorry, Danish asset owner. So, because at this point we have index, we have tracking error, so everybody from the CIO and up is happy. So, how do you put it in place, and what did they learn?
The story of this Danish pension fund is it's a public pension fund that already had, they explained it very clearly in the paper. So I'm just quoting them in a certain sense. They already had a low carbon index. They name it in the paper, but let's say that we name it M, not 2. And with M, they were suffering, they explained it very clearly, over allocation to the tech companies and under allocations to the oil and gas. And so the risk department was not very happy with the levels of risks. And so they said, okay, it was good as a first step. They invested their entire equity investments into these indices. But a couple of years later, when they heard about what I was doing on the carbon budget, they said, maybe it's time to revisit the problem or the situation and to figure out if there's a new generation of indices with limited portfolio construction risks. And then they made a tender offer. So everyone had to come with their best available solution in terms of sector deviation and tracking error. And they came to the conclusion that the one that S&P had been presenting was fitting with their objectives. And then they decided to shift their entire equity portfolio. And with two legs, it's totally public information, of course. The first one is purely an index one being managed by Amundi for more than 3 billion euros. The second one is interesting because it's managed by Nordea, the underlying of a smart beta strategy. And here it's very, very interesting because we all know that with smart beta strategies, you tend to over allocate to low vol companies and so on. You have all these risk factors and so on. And so you already twist the portfolio. And if the underlying index has itself some sector bias, then you combine two sector deviations, and then it becomes complicated to know where the performance is coming from, where are the risks, and so on and so on. So to have an underlying that is much more that is really sector neutral, brings another quality to the strategy. And at the end of the day, they shifted 100% of their equity investment.
Yep. Yeah. Fascinating. It is, it is exceptionally interesting. Right? So I guess one of the things that is exceptionally interesting is their process to get there was a relatively long one. Do you think that is the way it is required for asset owners to do this because they have to get used to certain concepts, or is this a time frame that you think is going to collapse as more of them do it and the other ones see the other ones have done it?
Actually, I would say that it was pretty short, actually, because I'm not sure exactly, but I think we spoke to them in May. I was making a roadshow in Denmark in May 2023, and they took the decision in September of the same year.
Oh, is that fast? Oh, I thought
Yeah.
I thought it was the next year. Oh,
No, 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 no. After that, no, they took the decision September, October. After that, you always have some homework to do. The portfolio with the portfolio with the asset managers, and so it was
well,
implemented.
that's actually kind of mind-blowingly fast.
Yes, no, that's why you're saying, wow, they are very slow. And I thought, gosh, you had the summer in the
That's pretty
meantime,
good. That's pretty good.
and
Yeah,
and
vacations. Yeah,
so
yeah,
I
that's all
thought it
right.
was pretty hard with them.
Yeah. I mean, it is fascinating. Was there anything that you all found, particularly when you were writing the paper? Was there anything that you all found particularly interesting that you think that members should go in with before they read it? What should they think about as they're reading it?
Three key messages, and we already spoke about the two of them, meaning that the macro hedge, the fact that against the usual belief, it's feasible to be net zero with limited portfolio construction risk. And really and to everyone I've been speaking to, everyone is almost falling off his or her chair saying, wow, really such a low tracking here. That's really important. But there's a third point, the very third point, is that when you have this IPCC aligned approach, then something obvious comes to your mind is the fact that the carbon budget shrinks with time. And so the 300 that was available, as IPCC said in 2021, is only 155 in 2024. And we spend about 37 per year. So the carbon budget that the planet has is shrinking at high speed. And, and that's exactly what IPCC has said for years. For years, they have said, we can tackle climate change, but the window is closing. So hurry up. And what is really fascinating is that although that was a loud and clear message for years, none of the financial products had integrated the cost of inaction. Name it, but green bonds, EU taxonomy, EU indices, whatever. And the paper that Patrick, Marcin, and I, we published in the CFA in 2022 was the first one to say, no, we should integrate this cost of delay. And very concretely, in 2024, to be net zero, it's minus 30% or per year, or minus 70%, 70, followed by 7. And when you compare with the AU indices, where you have either minus 30 followed by 7 or minus 50 followed by 7, you see that the cost of inaction has already deteriorated the terms and conditions. And once we have published the paper, just in March 2022, so almost yesterday, the paper immediately got the attention of very well-known or renowned institutions. The European Central Bank referred to this cost of delay and the impacts of the decarbonization rate. The GFANS dedicated an entire paragraph in one of their reports. WWF dedicated its entire report for NBIM. And in May of this year, in 2024, the NGFS, as you know, the group of 100 central banks dedicated to climate change, dedicated an entire paragraph as well, saying, of course, you must integrate the cost of inaction. So it's really interesting because that's a macro hedge, low portfolio construction risk, and integration of the cost of inaction. And the cost of inaction is first order, because if you divide the 155, that is the current budget, by 37, what we spend now, you found around 4. It means that we only have 4 years of carbon budget. And then everything, yeah, you have it. And then, all the debates about, the data quality, and we have a very limited period of time. So the time urgency, that again, science is saying is the problem, then that this time urgency for the first time ever is integrated into a product by a pension fund for a very large deal. So it's feasible.
Thank you, Fred. It's a great paper, great points. If the folks listening to this missed any of the details, the paper is called Reconciling Portfolio Diversification with the Shrinking Carbon Footprint. You can find it on CFA Institute's website. So I think it's on the homepage now. And you can just find Fred on LinkedIn and find all the things he has there. A couple of quick things before we go. So if you're interested in learning more about some of these trends and the portfolio construction issues related to them, CFA Society New York has our 11th annual Sustainable Investing Symposium. So for January 29th, you can sign up for it at cfany.org right now. And if you remember, something Fred made reference to earlier, smart beta portfolios, we had an exceptionally interesting presentation from Wilshire on some new thinking in smart beta. That video is also available on our website. You can log in there and get it if you're a member. If you're not, please join us. So Fred, thank you again for being here.
That's been my pleasure, really. And I would like to thank CFA in 2016. Patrick Bolton, Matt Sanderson, and I, we published Hedging Climate Risk. The paper worked very well. It was the first one to make the case that we could hedge climate risk with indices. The paper has been quoted more than 500 times. A couple of years later, we published this new version with the cost of delay. Now we have a case study. I think that CFA has been fantastic at conveying the messages that it's feasible. And some investors are really doing it. And if it's true for AP4 at that time, now PenSam could be true for others.
Yes, why not? Yeah, why not? Indeed.
Right.
All right, thank you, Fred.
Thank you very much, Rob. It has been a pleasure.